You got to find the bandwidth in your life that you can do the things and understand and know this is a grind.
This podcast is for educational purposes only. Nothing you hear on this show is legal or investment advice, nor is it an offer to buy or sell securities. Always consult your own legal and financial professionals before making decisions. Welcome back to another Capital Flow podcast. I'm your host, Dallon Schultz. If you're looking to raise $100,000 or more from a single investor, this is the show from you. Every single guest we bring on has experience in raising capital, operating funds, or as an asset manager in the real estate space. So we got really exciting guests with us today. Jeremy Dyer. He is the VP of Capital Formations at Rise 48 Equity. A lot of you have probably heard of them. Incredible group with Zach Haptonstall. But prior to that, Jeremy has raised over $45 million in the last 2 years while working a full-time job prior to partnering up with Rise 48. So we're going to get into some incredible stuff today. Jeremy, thanks for joining us.
Yeah, thanks for having me, Dallon. Appreciate it.
So, and Jeremy, you're actually out of state, but we were just happened to jump on a call a couple of weeks ago, coordinate it, and so glad you can make it into the studio.
Yeah, absolutely. Good to be here. Originally from, obviously, Minnesota. Still live there today with my family of 6. And down here visiting some properties with Rise 48 and meeting with the leadership team.
So this trip to 70-degree Arizona weather is prime right now.
Yeah, the morning I left, it was minus 3 degrees.
Sheepers. Well, Jeremy, again, really, thank you so much for coming in. And I always prefer the in-studio. It's just a lot better connection. I feel like stronger conversation. So to our listeners, share with them a little bit about your background before you got into the sales and raising capital.
Yeah, I appreciate that. You know, no rich uncles here, right? Kind of a self-starter all my life. I call myself an achievement addict. I think I was probably born that way. And so I was one of those kids that, you know, just always knew that he had an entrepreneurial itch inside of him. I just needed the opportunity to scratch it. But I always had a passion for sales. Both my parents were in sales. I was able to really hit the ground running, you know, right out of business school. Got a sales job, and first year I was Rookie of the Year in all of North America. By year 2, I was the number 1 guy in North America, crushing commission checks. Fortunate and blessed to be the number 1 guy for 20 out of the last 24 years, you know, in my space. That all enabled me and my wife to really be in a debt-free position. So by the age of 24, I was completely debt-free. I had my dream home paid off. I had the 40-foot RV sitting in the driveway, had a couple of kids. You know, life was going good. My wife decided to step away from her W-2 job real early on as well. And quite frankly, I would say by the time 2012 hit, we got bored. And my wife wanted a work to do outside the home. And I just happened to have some excess dry powder on the sidelines. So we tried our hand at actively fixing and flipping houses because that looked super sexy on HGTV, right? So we launched a company back in 2012 to actively fix and flip homes, wholesale houses, all in the single family space. We did that for a few years and we did quite well. The challenge is in 2015, we decided to double down on kids. We went from 2 kids to 4 kids. If you're reading between the lines, numbers 3 and 4 are twins. And we did make the decision. What I mean by that is we chose to adopt 2 kids from Wuhan, China. Most people at that point in history were unfamiliar with the name Wuhan, China as a real place. And now it's a very popular place in our history, hopefully. So we made that decision back in 2015. And honestly, it was a great learning experience for us. We did well in the space. It allowed me to learn about renovations on the single family home side of the equation. The challenge is I needed to step off of 1 horse. I was riding 2 horses at the same time. One was a highly paid commission job, and another one was building up an active real estate company. And so in 2015, we decided to step out of the active side of real estate home ownership, and we went completely passive. And to be honest with you, that first investment that I made as a limited partner investor, I held my breath, I plugged my nose. Truth be told, I had no idea what I was doing, okay? I knew that I liked and trusted the sponsor. Beyond that, I couldn't even tell you what the word syndication meant. Okay. So literally that was my approach to getting into real estate investing, was literally just to rip that Band-Aid off. But the one thing that I did know, Dallon, is I wanted to stay in real estate in some way, shape, or form. I just didn't have the time, the effort, or the bandwidth in my life to continue. But I also wanted to seek diversification outside of Wall Street and into Main Street. But I didn't want to be the active operator anymore, right?
Yeah.
Yes. And second to that, obviously the tax benefits. That's not why I got into real estate investing, but that's why I stay in real estate.
Incredible. A lot to unpack there. And unfortunately we got a short time here. I want to touch on the sales role for a little bit. Sales comes up quite frequently in what we do. When we're raising capital, you are 100% in sales. There's a lot of people that struggle on this side of the business because of their thoughts, beliefs, mindset around sales. Now, obviously you have a very, very successful career in sales. So for that person that's might be struggling, having those challenges, they don't want to be that salesperson. What could you share with them? What have you experienced in your role as a successful salesperson that could change somebody else's mind?
Yeah, and obviously it's a mindset thing. And to be full disclosure here, I have a competitive advantage in the capital raising space, and that is I've had a 2-decade-long run in a professional day job where I've nurtured and cultivated relationships with hundreds of people that already know, like, and trust me, right? Mm-hmm. But I was not able to get to that point without understanding in sales, it's all about relationships. I mentioned it before. If you treat people like transactions, right, that's not going to be effective. If you start treating people on a human level with respect and you build an authentic, genuine relationship with others, that's where it stops becoming a sales job and starts becoming just doing life together, right? So I always tell people, if you're going to get into the capital raising space, the best thing you can do is make an investment in yourself, right? Put in the reps. Don't treat people like they're transactions, but have genuine, authentic connections with people on a human level to let them know what you're up to. And once you have that type of a mindset that we're not chasing after capital, but rather we're becoming a magnet for capital, I think that your success in the space is going to be 10x.
I love what you just said there. I ran a workshop the other day and we were talked a lot about sales in it. Now the focus was raising capital, but if people don't have that right mindset around sales, it's hard to have that next conversation. And so I posed a question. I said, share with me the difference here. Are you raising capital or are you attracting capital? And what are you telling yourself in your head? Because that magnet reference that you made, when you're attracting capital, it changes the way you act. It changes the things that you do, the conversations that you have. So I love that you brought that up, because it's anyone that's been successful in raising capital in real estate, you know that it's not forcing the deal upon people. In any sales industry, you can't force a product or service upon anyone, but it's helping them along their journey, help them recognize that what you have is a solution to some of their challenges. So as you reflect back on your sales journey prior to raising capital, was there I don't know if a power move is the right move, but was there like a thing that you knew that you could rely on a good portion of the time that would get that relationship to where it needed to be to have that person say yes?
Yeah, honestly, again, it's on the backs of my reputation. We all have a certain amount of brand equity, and we build that brand equity one drop at a time, and we lose it in bucketfuls. So it's really important for people to understand that's how important this business is, because people are not investing in the sponsor. They're not investing in the pitch deck. They're investing in you, right? They're gonna deploy 6 figures of their hard-earned capital into your next opportunity because they know, like, and trust you. But it takes time for people to build that up. And that's honestly something that we're borrowing from. Second to that, those that are in the capital raising space, if you're raising capital for another sponsor's deal, you're leveraging their brand and their ability to be able to execute on that said business plan, which can be very risky at times, which is why it all comes down to, capital raisers aligning themselves and partnering with, best in class gold standard sponsors in the space, because you're staking your reputation on their ability to execute the business plan.
100%, because when you're partnering with people, and that's something I think important for our listeners to know if they're newer to the space, you don't have to be the one sourcing the capital, finding the deal, managing the asset. That's why I think you and I are really drawn to commercial real estate and multifamily investing, is because it's a team sport. So you find the area you like, and then you partner with people that complement you. And what I share with people is because we partner with people just like you did prior to working with Rise 48. If that deal goes south, our investors aren't going after that operator. We're the ones that have to have the conversations because they trusted us and we said, hey, this is a good deal. This is why we're putting money into it. This is why you should partner with us. And so it's critical, super critical to make sure you're vetting that operator. And one of the biggest mistakes that I find new investors, new LPs make is that they spend 80% of their time vetting the deal. I think that's important. But when have you ever seen a bad deal on paper, Jeremy? They all look good.
Yeah.
And so what we do is we flip the script on that and we coach and teach and educate people. You need to be spending 80% of the time vetting that operator. And then 10% of your time vetting that market. What market are they investing in? And then the remaining 10% on the deal itself. And the reason we encourage that is because if you spend 80% on the operator, 10% on the market, you're doing what we call stacking the deck. Things happen in real estate. People are usually pretty understanding. But if you do your due diligence on that first 90%, even if the deal's not great, a good operator in a good market can turn that deal around. So, okay, so let's talk about your transition into limited investing, being an LP. That can be very, very difficult for investors to do, especially when they have experience actively investing into deals. So share with us a little bit about some of those thoughts, challenges, things that you had to go through to be comfortable getting to that point.
Yeah, I mean, honestly, I was I was in charge. I was the one calling the shots. And so I was giving up some control, right? So now I'm trusting in some other third-party entity or team of people to execute on a business plan that I was previously responsible for executing upon, right? And so I do really appreciate, your perspective on the execution side, right? And that's really what it all comes down to in this space, right? Is that sponsor able to execute on that business plan? And that's why it's so incredibly important that people spend the majority of their time not evaluating the deal, the pitch deck, or even trying to stress test the financials, which the truth is that most people don't know how to do that effectively, right? You need to look under the hood, behind the curtain, et cetera. And the real main way that I was able to do that is really honestly by deploying my own capital with those sponsors to test the waters. So we can all say that we've done our own due diligence on the sponsor, but truth be told, the only way to really do that is to actually invest in one of their deals. Which is why through my company, Starting Point Capital, why my requirement is to have invested at least twice with an operator with my own capital before I bring one of their future opportunities, to our investor network.
That's huge. And one of the, in regards to vetting operators, I think this is good because there might be somebody that has $50K that they're wanting to invest and they're not sure what to do with it. With the fund of funds that we operate, we won't even look at a deal. We won't even consider an operator unless they've been in the business minimum of 5 years and minimum have taken 5 deals full cycle, meaning they purchased, executed, and exited. And what's interesting, a few years ago, 2020, 2021, everyone looked like a freaking rock star. So it's been interesting going through 2024, now coming into 2025. It's going to be interesting to see who's still standing. And I think that is going to be who's still standing after getting through these last couple of years. I think that says a lot about who they are and how they operate.
Yeah, and what you're saying there is obviously, your desire as an investor or as a fund manager is to really, co-invest or bring opportunities to investors where you're increasing the likelihood of a predictable outcome, right? That's really what we're looking for here. Well, what sponsors out there that exist today are able to execute that and truly increase that likelihood of a predictable outcome? And we have a great test case with the historic rise in interest rates, right? And I know for a fact there are sponsors in the space today that are selective in their track record slide, right? They're cherry picking certain deals to communicate to their investor audience. And they have to do that. Why? Because if they disclose the distressed deals, the deals that they've had capital calls, there's been a loss of capital, they've missed debt payments, the likelihood of them being able to raise capital on this next deal is going to be a lot more challenging. So I encourage all investors, if you want to do proper thorough due diligence on a sponsor, you need to dial in to their 21 and 22 acquisitions. Because if they were an active operator, not just selling deals at the peak of the market, but they were buying deals at the peak of the market, I think that unpacking where they're at, financially speaking, in those deals is a telling story. And every sponsor in the space that bought deals during that time is in some way, shape, or form distressed on the financial side.
Hey, as a business owner or entrepreneur, one of your biggest struggles is raising capital. Maybe you've gone to the bank, maybe you've been turned down, or maybe you just have never thought of before speaking to investors. The reason the people here at Copless Pro, Dallon and Paul, have decided to partner with us over here at Capital Connections is we not only teach people how to attract and raise capital, we actually put you in the rooms where the capital flows. That's right. My name is Brad Blazer, and I've raised over $2 billion. And over the last 5 years, I have personally taught and mentored hundreds of people around the world on how to attract, raise, and close capital so they can be doing something bigger in life. But it's not only the coaching and mentoring. While we're working together, I put you in rooms of curated events with family offices, broker-dealers, and registered investment advisory firms. That's right. We create the proximity to my network because we know that proximity is power. It's our belief and our finding that no other company out there offering services in the capital raising space is doing that, which is why we have forged this strategic relationship. If you'd like to learn more, click the link below that's provided here in this podcast. And this is Brad Blazer saying we can't wait to work together.
So what is the operator doing to help protect and preserve investors' capital in those deals? And there's a lot of different levers that sponsors can pull, but the biggest one is how much liquidity do they have, right? Are they willing to, reinvest their own capital into those deals in order to protect and preserve investors' capital?
I'm glad you brought this up. I was talking to somebody the other day. I go to church with him, and he found out that I was in the multifamily investment space, and he was attending one of these 3-day conferences with these coaches, these gurus, say, hey, this is how you get into apartment investing. You get 3% acquisition fee. That's your income. You get a few of these deals a year. And he called me to ask of my recommendation, my thoughts on it. And I think mentorship groups can be incredible for the right people. That's how I got jump started, but I think it attracts a lot of people that shouldn't be in there. And one of the main points that this person brought up to me was like, yeah, the acquisition fee, like that's what we could take as income. And I said, you know what? If that's what they're teaching you and that's your whole reason of going into this, don't do it. I said, we won't even partner with an operator if we find out they're taking that AC fee as income. Mm-hmm. And the operators we partner with, they roll that into a reserve. They don't need it. And they would rather have it there for a rainy day so they don't have to come back to their partners and ask for more capital.
That's right.
And so to our listeners, just something to keep in mind. Like if somebody's like, if you see that they're pulling that AC fee for themselves, then just question it. Just dig deeper.
Yeah, really for me, it's the attention, right? Are they choosing to focus on the next deal that they want to transact on, the next deal that they have under contract that they're going, through due diligence processes on because they want to, benefit from that acquisition fee or due diligence fee. They want to add to their AUM fee, right? Or, or are they focused more on those opportunities that they partnered with investors 3 years ago, right?
Yeah.
That aren't doing well.
Yeah.
And so when a sponsor has distressed deals, they have a tendency to take their eye off the ball, right? Well, that's all telling for limited partner investors and fund managers to know. If you're looking to partner with an operator that has deals that they transacted on, during the last, peak of the economic cycle that are now under distress, how focused are they on preserving investor capital in those deals? Or are they instead more laser focused on collecting that next acquisition fee?
Yeah. So you've invested passively in a lot of deals, and then with your fund as well. Have you been through a situation, without disclosing any names or companies, where you had to go through some unfortunate news, some capital calls? How was that communicated to you? How do you manage similar things if it happens again?
Yeah, it's a great question. So I'm in 35 active deals right now as a limited partner
and
investor.
This is you. This isn't with your fund.
This is just me.
You.
Yep. This is Jeremy and Marlene Dyer's family trust. 35 deals as an LP investor, dozens of sponsors, a handful of different asset classes, different geographic locations, different business plans, different debt structures, you name it. Okay, We're in it. And those are the only deals that we're in currently. We've had several full cycle deals as well over the years. But in full disclosure, I lost 100% of my capital on a deal in 2024, and I had 4 capital calls, which I chose to participate in for various reasons, right? So I've been there, done that. And the one thing that I have learned through that experience is I will now, going forward, only partner with operators that are vertically integrated, okay? That was the one common theme between those 5 deals. 1 was a total loss of capital, 4 were capital calls. The one thing that all of those had in common is they were all with sponsors that were non-vertically integrated, okay? They had third-party property management. In a couple of examples, the property management firm was replaced 1 year and then replaced the second year. That's a major disruption.
You can't operate efficiently if you're constantly swapping that out.
It's a major disruption to the business plan, right? Occupancy fell. There wasn't enough liquidity built in on the reserve side to afford, rainy day type scenarios. For example, what happened with the cost of insurance going up, property taxes going up. They just weren't able to execute their business plan because the bank in that scenario is not willing to reimburse your CapEx dollars, right? If your debt service coverage ratio is below 1 and you can't even afford your debt payment.
Yeah. I'm glad you brought that up, because that is one of the main things we look for as well, is are they vertically integrated? Do they have property management in-house? And it's hard once you partner with a group like that, or groups like that are vertically integrated. It's hard to consider others. It really is, because you see, typically they tend to have their systems, their operations, their processes in place. They have a little bit more control of the situation, and sometimes they can be a little bit more competitive because they can control that, and you don't have these third-party management fees just trying to rake everyone over the coals. So in your experience, when you decided to start raising capital for these real estate deals after you've participated, what was one of the biggest challenges you had going from this full-time sales position to, hey guys, I'm investing in real estate?
Yeah, honestly, it was kind of changing my perception, how people view me.
Okay.
Historically, they've known me as Jeremy, technology sales guy, for over 2 decades. And now I was going to market with a completely different persona, a different brand, right? Now Jeremy's real estate guy, right? He's not technology sales guy. And honestly, it took me 6 months to get there. So I spent 6 months kind of changing my brand identity, primarily using social media. So I started with just 2 posts a week, and then it grew to 4 posts, and now it's 6 posts a week, right? On all kinds of different platforms. But it was a slow process. And really, honestly, it was me telling my story, right? I'm not telling people that they need to invest in real estate. It was really more me telling others what I've been up to since 2012 when I got into real estate, right? So I had a decade-long, track record as an individual investor, both on the active and the passive side, and I wanted to let others know what I was up to. Well, the main genesis behind that was obviously to change public perception of who Jeremy Dyer is. But second to that, it was really to create an environment that piqued curiosity in my followers, in my network. And so the amazing thing about after having done that for 6 months, when it was time to partner with an operator to raise capital through the fund of funds model, I had multiple 7 figures sitting on the sidelines ready to deploy day one.
Because they were watching you and you were sharing your story. And you said something in there that I think is a hidden gem that if you're people newer to raising capital, I think often miss. You shared your story. If you can sell through stories, you don't feel like that typical salesperson that idea of that salesperson that you think you might have. And I think that's what people fail to realize is that's really all you need to do. Just share your story, share your experience, put it out there. You've experienced this. I know I've experienced it. Paul's experienced it, where we're putting stuff out and then we extend an invite to somebody, and times where I'm like, I don't even think they're interested. I'm probably not even going to invite them. And they're like, yeah, I got 100K. Let's go.
Oh.
I've been watching what you've been doing for the last 6 to 12 months.
And you're spot on there. I mean, I have investors today, fast forward now 2.5 years into this, I will have people reach out to me today that will tell me, I've been following you on LinkedIn or following you on Instagram.
And you had no idea.
And they've never once liked anything. They've never commented on anything. And all of a sudden, they're coming out of the woodwork with a $100,000 check to deploy. And oh, by the way, they're bringing their own network into the deal as well.
Love that. And that's when you're like, okay, it's all working. It's all coming together.
That's right.
So Jeremy, we're out of time, and it's been great. We could talk more and more. We'll probably have to get you in here again.
Be happy to do it.
So, but to our listener, when you consider somebody that might be newer or just trying to get to that next level of capital raising, when you reflect back on your journey, what's that one gold nugget you could share with them?
Yeah, the one thing that we really haven't addressed at this point is really the power of leveraging other people's networks. We talk about the power of leveraging other people's money, but let's talk about their network, right? So I really threw gas on my capital raising efforts when I started asking people for help. It's a really simple conversation, but it's very difficult for, I think, Americans in general to ask others for help. But the amazing thing is when we're asked for help, we'll happily give it. So when I started having conversations with my existing investors to let them know that I'm looking to grow my business, the greater amount of capital we bring in to deals, the greater the leverage we have, the better the return economics are for our investors. And can you please help? Sure, Jeremy, what can I help with? Is there 1 or 2 people in your personal or professional network that you think we can help in the same way we've helped you? And then you shut up. And the amazing thing happens. They say, yeah, there's actually 1 or 2 people I've been thinking about, right? Great. Can you introduce me to that individual via text or email, and I'll take it from there. That's it.
It's a simple invite. Yeah. Simple invite. And going back to how we started this show, attracting capital. That's just what keeps coming to mind as we had a conversation and think about your experience. And you do that by putting stuff out there. And you started simple. You said 2 posts a week. Yeah. That's all it took.
It's just being consistent with it. And sometimes you have to show up, and sometimes you have to open your mouth, right?
People want to know you're committed. So I was in the medical field before real estate, and it's funny you brought up 6 months, because that's when that 6-month period is when I started getting those outreach, people reaching out to me. And so that 6 months seemed to be whatever the secret number is to that rebrand. So I was no longer down the medical professional. I was like, oh, okay, he's a real estate guy. Yeah. But leading up to that, while I was still in the medical field, I was posting and sharing little things. I just put fuel on it. Yeah. I decided to go in full time.
So the takeaway for your listeners is, listen, if you're stagnant in your capital raising efforts, or you're looking to get into the space for the first time, you need to be consistent and don't stop. Like sometimes people get 2 months in and they're doing what we tell them to do, right? They're executing the playbook, but they're not seeing results. Little do they know, if they just stay at it for another 2 to 4 months, get to that 6-month point, right? they're going to start seeing results.
Yeah.
But you got to stay consistent with it. You got to find the bandwidth in your life that you can do the things and understand and know this is a grind. Okay. I can't AI automate my way or systematize my way through capital raising. I have to be willing to be vulnerable with my investors. I have to be willing to connect with them one-on-one to build that genuine, authentic relationship with them. And that's the secret sauce.
Yeah. And I think even more so in this world of AI and automation, and we use a lot of automation in our business, but there's a time and a place for it. And I think that the secret sauce is going to be when people can bridge those two together.
That's right.
And the way we utilize it is really as a gatekeeper, because as soon as you start gaining traction, as soon as you start getting experience, there's a lot of people out there that will just want to pick your brain. And it's hard to say no, because we've all been there. We want to learn. But what I found is that if you don't set boundaries of your time and value it, people will take advantage of it. So finding good tools, resources, things out there that can help gatekeep and accelerate maybe that initial part of the interaction. But to your point, capital is raised by breaking bread, sitting down, talking to people, and getting to know them one-on-one.
That's right.
So, Jeremy, this is a pleasure. Really appreciate it. How can our listeners contact you?
Yeah, appreciate the mention there. So you can connect with me on LinkedIn. I'm very active on that platform under Jeremy Dyer. You can also reach out to me via email, jeremy@rise48equity.com. Lastly, recently published a book back in November.
Excellent.
Yeah, and so it's called The Fundamental Investor. You can grab it on Amazon. You can head over to fundamentalinvestor.com. The major genesis behind writing that book, obviously, is to share my story with others. Hopefully, it's an inspiration to potential limited partner investors, and we certainly encourage other fund managers to also recommend the book to their listening audience. I'm not here to compete with you, but I'm here to help you, right? Help you become a better version of yourself, help you to communicate and really train, educate, and nurture your prospective investors.
Awesome. And we'll be sure to put those links in the show notes as well. So awesome to our listener. Thanks for tuning in to another Capital Flow podcast. Again, if you're looking to raise $100,000 or more from a single investor, this is the show from you. Jeremy, thanks so much for your time and looking forward to future conversations.
Dallon, thanks for having me.